Welcome to a new episode of the podcast. Vox Agent is made by AI for business executives that work with AI. Today, we are doing a critical deep dive into something that's really shaken up the market's confidence in this whole AI boom. We're talking about the huge $1.1 billion bearish bet that the big short investor Michael Burry placed against some of the biggest names, specifically NVIDIA and Palantir. And this is way more than just, financial gossip.
It absolutely is. It's a strategic alarm bell. So our mission today is to get past those headlines. We're going to dissect the real, multifaceted impacts of this skepticism. Because for you, the executive, this isn't just news. It's a catalyst. It forces this urgent reevaluation of your own enterprise strategy, your investments, and maybe most importantly, your actual risk exposure in the AI sector right now.
Okay, let's unpack this. A billion-dollar trade is a massive statement, and when Burry makes a statement, people listen. So what exactly is he doing here, and what's the core argument driving it?
Right, so the mechanism is key. He's using what are called put options. For anyone who's not familiar, a put option basically gives you the right to sell a stock at a set price in the future. So, in simple terms, it's a very expensive, very high-stakes bet that the share price of NVIDIA and Palantir is going to fall a lot.
And what is he fundamentally betting against? Is it the tech itself?
No, not the tech itself, but what he sees is just irrational valuations. Burry's thesis is, at its heart, an indictment of market exuberance. He thinks the stock prices are dangerously disconnected from, actual profitability and the real operational costs. It has echoes of the dot-com bubble or even 2008.
Okay, let's put some numbers to that irrationality. What were we seeing at the time of this bet?
Well, take a company like Palantir. Around the time he made this move, it was trading at a forward price-to-earnings ratio of over 250.
250.
Exactly. I mean, to put that in perspective, that ratio is basically what investors will pay for $1 of future earnings. A number like 250x demands decades of just perfect, flawless growth. It's extreme optimism.
But his critique goes deeper than just that PE ratio, doesn't it? I heard he was looking at the accounting, specifically around AI hardware.
You're right, and this is where it gets really interesting. He's looking at the cost structure. Burry is suggesting that big tech firms aren't properly accounting for the incredibly fast depreciation of their specialized AI hardware.
You mean the chips, the servers?
The chips, the servers, the cooling systems, all of it. This stuff has a much shorter useful life than your typical IT equipment. So if the real long-term cost to maintain all this is way higher than what's on the books,
then the stock price is built on a shaky foundation.
Precisely. It doesn't reflect the long-term financial reality of running an AI-heavy business.
So the skepticism is aimed right at that gap between the promise of AI and the messy, expensive reality of actually integrating it.
That gap is the absolute pillar of his argument. Our sources show that almost every organization is using AI in some way. The enthusiasm is there, but, and this is the key, that enthusiasm hasn't turned into scaled value yet. A global survey found that something like 2/3 of organizations have not yet started scaling their AI initiatives. They're still just experimenting.
So that chasm between the high valuation and the slow, on-the-ground adoption, that's where he sees the break coming.
That is exactly where he's placing his bet.
And that filing, it wasn't a quiet event. It made a lot of noise. What was the immediate market reaction when this all became public?
Oh, it's an immediate shockwaves. It almost acted like a permission structure for latent skepticism.
A permission structure. I like that.
Yeah, it's like a lot of investors were feeling nervous, but nobody wanted to be the first to say it. Burry's bet gave them cover. We saw widespread profit-taking, and Palantir's stock dropped, 8 to 10% on the news?
NVIDIA took a big hit, too. It showed just how fragile that rally really was. A significant dip, for sure. But the AI bulls, the people who are justifying those crazy valuations, they have a powerful counter-argument. And this is where it gets really interesting. It's this clash of ideas, right?
It is a clash between the fundamental value critique and this grand vision of technological transformation.
So what are the bulls saying?
Well, the bulls, and that includes analysts at major players like JP Morgan, they publicly push back.
Yeah.
They argue that traditional valuation metrics like PE ratios are basically irrelevant here.
They're relevant. That's a bold claim.
It is, but their argument is that AI isn't just another tech trend. They see it as a fundamental paradigm shift, something on the scale of, say, the dawn of the internet.
But isn't that what people always say during a bubble? This time it's different. Why should an executive listening now believe this vision is immune to Burry's critique?
And that is the core strategic dilemma. The bull case is that the technology is so foundational and its growth is so exponential that looking at today's earnings is just missing the point. They see a company like NVIDIA as providing the literal picks and shovels for a whole new digital economy. They argue Burry is, missing the forest for the trees. He's looking at last quarter's numbers while they're looking at a 10-year revolution.
So for the executive trying to make resource decisions today, this is the fork in the road. Do you trust the hard numbers, the value fundamentals, or do you bet on this grand secular growth story?
Exactly. You have to decide if the current market is driven by speculative FOMO fear of missing out or by a genuinely irreversible economic shift that's happening right now.
Okay, let's shift gears. Let's move away from the stock tickers and talk about the organizations actually using AI. If Burry is right and this market recalibrates, how does that change strategic planning for everyone else?
A market recalibration forces an immediate pivot. It's a shift away from that growth at all costs mindset we've seen toward a very disciplined, value-oriented approach that demands a clear return on investment. So as an executive, you now have to draw a very sharp line between AI projects that give you clear, short-term efficiencies and those more speculative, transformative projects that might not pay off for years.
Can you give me a practical example? What does that look like in a high-stakes field like, say, healthcare?
In healthcare, the initial excitement is definitely being tempered by reality. I mean, we all saw the challenges with huge projects like IBM Watson. That's a powerful cautionary tale. So now, new investment in something like diagnostics or personalized medicine, it's going to hinge on demonstrable proof of clinical efficacy and a clear, measurable financial return. In a contracting market, you just aren't going to get a multi-million-dollar check signed based on promise alone.
And that naturally slows down adoption for the really ambitious stuff.
It slows it dramatically, and you see a similar pressure in capital-intensive industries like manufacturing.
Right, they need to spend a lot up front for big automation projects.
Exactly. The long-term outlook is great, but in a capital-constrained world, those big deployments get delayed. Companies will prioritize projects that guarantee an immediate ROI and push those longer-term transformations onto the back burner.
So there's all this pressure on R&D budgets, but doesn't this skepticism also create maybe some strategic M&A opportunities?
Absolutely. And this is the silver lining for established companies. When skepticism spreads, venture capital gets a lot more selective. You could see a funding winter for a lot of these cash-burning startups that don't have a clear path to profit.
Yeah, and that means?
That means it's a buyer's market. For a company with a strong balance sheet, it's a perfect opportunity. You can acquire incredible AI talent and technology at much more reasonable prices as those inflated startup valuations come back down to earth. The whole focus shifts to buying companies with proven business models.
So what does this all mean? This whole situation really highlights the systemic risk in the AI sector. How do you build resilience against this kind of volatility?
The main imperative is to move AI risk management up from the IT department and into the boardroom. This volatility puts a huge premium on corporate governance and financial transparency around your AI bets. Boards need to have solid frameworks to manage not just the ethics, but the financial and operational risks. Things like model fallibility, vendor risk, and of course, the massive cybersecurity threats that come with this technology.
And regulators are watching this closely, I assume.
Oh, very closely. Even the Bank of England has pointed out how AI could concentrate risk and affect global financial stability because everyone is becoming so dependent on the same few platforms.
It's interesting, though, because AI itself could be part of the solution there, couldn't it, for better governance?
It's a paradox, but yes. AI can be leveraged to enhance governance. It can provide unbiased insights, analyze huge data sets to spot risks, and improve the accuracy of financial reporting, so you can use the tech to build a stronger defense.
Okay, let's distill this down. For the executive listening right now, what are, say, 2 immediate actionable things they should be doing to mitigate the kind of risk Burry is highlighting?
Okay, 2 things. First, focus intensely on diversification and resilience. You have to actively mitigate your technological concentration risk. That means avoiding over-reliance on a single AI vendor or a single platform.
So don't put all your eggs in one basket.
Do not. If a key vendor hits a rough patch, you can't have your entire business model hinging on their success. Diversifying your tech dependencies is your core defense.
And the second thing?
Second, mandate a fundamentals-first investment thesis. This means you have to do the hard work. Conduct rigorous financial analysis and stress test every single one of your AI-dependent business models against a market correction scenario. You need to know, right now, which of your AI projects are still profitable and mission-critical if your budget gets cut by 20 or even 30%. That focus on demonstrable value over hype is your most reliable shield.
So we've really navigated the skepticism, the fundamental critique of these valuations, and the strategic pivots that are now required.
Hmm.
This shift from unbridled optimism to cautious prudence feels very real.
It is real, and it's mandatory. Look, the long-term potential of AI is still immense. Nobody's really disputing that. But the ultimate provocative question for you to take back to your team is this. If Burry's thesis plays out, if we see a skeptical contraction, a kind of prolonged AI winter where capital dries up, are your current AI investments essential enough to survive the budget cuts? Are they proven? Or are they just speculative projects that are destined to be divested? Because at the end of the day, your resilience will be defined by that focus on demonstrable value, not on abstract technological hype.
Thank you for joining the podcast, and see you soon.